Hello viewers, it's Angie. Do you know, every year thousands of people receive unexpected letters, tax code changes or tax calculations from HMRC because of income they never realise might need declaring. In most cases, they weren't trying to hide anything. They simply assumed HMRC was only interested in wages, pensions, and tax codes. The reality is very different. Today, you see, there are at least 10 other income sources that can affect your tax position. Some of them may already be sitting quietly within your own finances right now. What changed is that HMRC's ability to match information from banks, building societies, investment companies, online platforms, and overseas financial institutions has become far more sophisticated than many people realise. So today we're going to look at 10 income sources that HMRC can often see, but which many people either forget about, misunderstand, or wrongly assume are invisible. As we go through the list, ask yourself, do any of these apply to me? Let's start with a more obvious one. Number 1, savings interest. It's one that is catching increasing numbers of pensioners. Many people still assume that interest earned on savings is private information between them and their bank. Years ago, that may have felt more true, but today, banks and building societies routinely provide information to HMRC. Now, if you have money in savings accounts, fixed rate bonds, building society accounts, or notice accounts, HMRC may already know about the interest being generated. And what catches many people out is that interest rates rose sharply, but the personal savings allowance did not. You see, currently, basic rate taxpayers generally have £1,000 personal savings allowance. Higher rate taxpayers generally only have a £500 personal savings allowance. So now it takes a much smaller savings pot than many people imagine to generate taxable interest. Number 2, rental income. Many people own a second property. Others rent out a former family home. Some operate holiday lets. Others take in a lodger. I've had questions about all of these. Now, the mistake many people make is assuming HMRC only becomes interested when the profit becomes substantial. But in reality, property income has its own strict set of tax rules. For example, the rent-a-room scheme can provide valuable tax advantages for people taking in a lodger, but letting out an entire property is a very different situation. And there is another important change that many landlords have not fully appreciated. The old tax advantages that once applied to furnished holiday lets have largely disappeared. That means some people may still be relying on rules that no longer exist. The important point is to recognise that rental income is something HMRC generally expects people to account for properly. If you receive money from property, it is always worth checking which rules apply to your specific situation. Number 3, online selling for profit. This is one of the fastest growing areas of confusion. Let's be absolutely clear. Selling your own unwanted possessions is usually very different from running a business. If you sell old clothes, furniture, books, household items, that is often very different from buying or making items specifically to sell for profit. HMRC may consider, are you buying items to resell? Are you making products to sell? Are you operating regularly? Are you trying to make a profit? Many people still think online selling through eBay or Etsy or Vinted, places like that, is largely invisible. But the world has changed. You see, online platforms are now legally required to share certain seller information directly with the tax authorities. If your trading income exceeds the £1,000 trading allowance, reporting obligations can arise. What catches people out is they often assume, oh, it's only online, or it's only a small amount. Those assumptions are becoming increasingly risky. The key distinction is simple. Selling your own unwanted possessions is one thing. Running an activity that looks like a business is something very different. Number 4, small self-employed earnings. This is where many people accidentally drift into taxable income without realising it. Perhaps you cut grass for neighbours, do occasional bookkeeping, tutor children, walk dogs, repair computers, sell handmade crafts. Because the payments often start small, people naturally think it can't really matter. But the £1,000 trading allowance applies across casual self-employed activities as a whole. HMRC is interested in the nature and regularity of the activity, not simply whether individual payments feel insignificant. Number 5, YouTube and creator income. "20 years ago, this barely existed. Today, thousands of ordinary people earn money online. Income can come from YouTube advertising, sponsorships, product promotions, online content. Many people begin as a hobby. Then one day they notice regular payments arriving every month. That is often the moment when a hobby begins to look more like an income stream. Number 6, affiliate and referral income. This is what people call invisible income. You recommend a product, someone clicks a link, a commission arrives, or perhaps a referral bonus appears in your account. Because these payments are often small and automatic, many people barely think about them. However, whether money arrives through a payslip or through an online referral system, it remains income. Number 7, royalties and licensing income. Now, this applies to many creative people. Income may come from books, ebooks, photography, artwork, music, digital products, and intellectual property. The challenge is that royalty payments often arrive months or even years after the original work was created. People simply forget about them, but digital payment systems and financial reporting generally don't. Number 8, and it's foreign income. Many people still assume that income earned overseas stays overseas. Increasingly, that is not how the world works. Examples include overseas pensions, foreign bank interest, overseas rental income, foreign dividends, and overseas investments. International information sharing agreements have expanded dramatically, you see, over recent years. And the days when people could assume foreign income was automatically visible are largely gone. Number 9, those dividends from investments. Many pensioners hold investments, perhaps through shares, investment portfolios, trading platforms, or investment accounts. Dividend payments often arrive quietly. No payslip, no invoice, no obvious reminder, just money appearing in an account. Because of that, many people underestimate their significance. What surprises many investors is that dividend allowance has been reduced significantly and now stands at just £500 per year. So it takes a much smaller portfolio than many people realise to exceed that level. And finally, number 10, capital gains. This is perhaps the most misunderstood area of all. Many people think, I bought it with my own money, so surely I can sell it tax-free. But certain assets can potentially create a taxable gain when sold. Examples may include shares, investment funds, second properties, certain valuable assets. And what catches people out is that the capital gains tax annual exemption now stands at just £3,000. A few years ago, that allowance was much higher, which means some people may still be making decisions based on rules that no longer exist. Because that tax-free ceiling is now relatively low, even a modest profit on a sale can suddenly become relevant for tax purposes. The rules are very different from selling ordinary household possessions, as we've discussed, and that makes this one of the most common areas for honest mistakes. Many people do not discover there is a potential tax issue until long after the sale has taken place, which is why understanding the rules before selling can be just as important as understanding them afterwards. Let me tell you what the big message is here. Because do you notice something important about this entire list? Almost none of these examples involve criminal masterminds hiding money in offshore vaults. Most involve ordinary people making perfectly understandable assumptions. The world has changed. HMRC systems now receive information from banks, building societies, employers, pension providers, investment companies, online platforms, payment processors, overseas tax authorities. That doesn't mean you've done anything wrong, but it does mean that many of the assumptions people grew up with about what HMRC can and cannot see are becoming increasingly outdated. So here's the safest approach. Keep good records. Know where your income comes from. Understand the key allowances that apply to you. Don't assume something is invisible simply because it arrives online, arrives from overseas, or only appears occasionally. And if you're unsure, check the latest HMRC guidance or seek professional advice, because the most expensive tax mistakes are often made by people who genuinely believed they had nothing to worry about. Do remember my disclaimer that this content is for general information only and is not personal financial or tax advice. It is based on current UK tax rules and public guidance for the 2026-27 tax year, and individual circumstances vary and rules can change. Do write me in the comments if you're unclear about anything here, and also if you need me to point you in the right direction regarding any information on what we've discussed today. And I look forward to seeing you very soon in the next video. I'm Angie. Goodbye for now.